Welcome to the Opening Bell Report.
I want you to just look at your calendar for a second.
Okay.
Because it is Tuesday, February 24th, 2026. And
time flies.
It really does. But if you're someone who has been, maybe ignoring your stock portfolio for the last 2 years.
Which honestly, I totally get. A lot of people have been doing exactly that.
Right, because things got scary. But if you haven't looked, I have some news that might actually shock you. I'm looking at a number on the board today that, honestly, if you told me this back in 2024, I would have laughed in your face.
Oh, I know exactly what you're looking at.
That number is $46.12.
And just to make sure everyone is on the same page, because that sounds like just a random price out of context. We were talking about Intel, ticker symbol INTC.
Exactly, Intel. And we need to just pause and sit with that for a moment, because $46 isn't just a number on a screen. It represents a massive, a literal 100% rally from where this stock was at its absolute rock bottom.
The 52-week low.
Yes. Do you remember when it hit $17.66?
Oh, vividly.
Yeah.
That was the ultimate moment of capitulation.
That was the ultimate moment of capitulation.
People were literally writing eulogies for the company. It wasn't just, Intel is having a bad quarter. It was
Intel is the next Kodak.
Exactly. Stick a fork in them, they're done. Legacy tech, all of that. And yet, here we are, looking at a chart that has basically gone vertical. So our mission for this deep dive is pretty simple. I've got this really comprehensive analysis report in front of me.
And it is thick. There's a lot of data in there.
So much data. It breaks down the fundamentals, the strategy, the psychology of the market. And I need to know, based on this report, is this a true return of the king scenario? Or is the market just completely getting ahead of itself?
Well, it is the $230 billion question, isn't it?
It really is, because when you just look at the headlines, Intel still seems to be the punching bag of the tech world. They aren't NVIDIA. They aren't AMD. So how on earth did they double in value? So to answer that, we really have to kind of change how we look at the stock market. I think usually we assume the market rewards success.
Right. Like record profits, massive growth.
Exactly. Taking over the world.
Yeah. NVIDIA posts $1 bajillion in profit, the stock goes up. That makes perfect sense to me.
But that is not what is happening here with Intel. The market isn't rewarding perfection right now. It is rewarding a very specific, maybe slightly cynical phenomenon that analysts call less bad.
Less bad.
Less bad.
That sounds incredibly underwhelming.
It does sound underwhelming, but it is a phenomenally powerful force in finance. The rally we are seeing to $46 isn't because Intel is suddenly printing money like it's 1999 again.
Right.
It's entirely driven by the realization that the bleeding has stopped.
The patient is no longer actively dying on the table.
Exactly.
Okay, let's dig right into the numbers from the report then, because I'm looking at this Q4 2025 breakdown, and I'm trying to find the wow factor.
It's hard to spot at first glance.
It is. Revenue stabilized at $13.7 billion for the fourth quarter. Okay. But if I look at the full trailing year for 2025, revenue was $52.9 billion.
Which, if you look at the previous year.
Right. It's almost identical to the trough of 2024, where they did $53.1 billion.
So it's essentially flat.
Exactly. It's flat. And in the tech world, flat is usually a death sentence. If you aren't growing, you're dying. So why is a company with effectively zero revenue growth seeing its share price double?
Because you have to look further down the income statement. It's all about what happened to the bottom line. You have to look at the net income. That's where the story totally changes.
Okay, I see it here. And yeah, this is stark. In 2024, they had a net loss of negative $18.8 billion.
Negative $18.8 billion. Let that sink in.
I know big corporations lose money sometimes, but $18 billion, that is the GDP of a small country just vaporized.
It was an absolute catastrophe. And that was the specific number that drove the stock down to $17. Investors looked at that insane burn rate and basically said, this company is heading straight for zero.
But then I look at 2025 in the report, and the loss shrank to negative $0.3 billion.
Right. So from a nearly $19 billion hole to basically breaking even.
But hold on, I have to play the skeptic here for the listener.
Go for it.
You were telling me the stock doubled just because they lost less money. This has still lost $300 million. In a market where their competitors are just minting cash, why should I be impressed that Intel only lost a little bit of money? It feels borderline delusional.
It definitely feels that way if you try to compare them to an NVIDIA. But you can't do that. Think of it this way. Imagine a house that is entirely engulfed in flames.
Okay.
That was Intel at $17. The market was pricing that house as if it were already a pile of ash.
Yeah.
But today, at $46, the fire is out.
So the house is just soggy.
Right. The house is soggy. It smells like smoke. The windows are completely blown out. but the fundamental structure is still standing.
Okay, so the stock rally is basically just Wall Street exhaling.
Precisely. It's the sheer removal of the bankruptcy risk. When Intel slashed that loss from $18 billion down to basically zero, the market realized, okay, wait, they aren't actually going to die.
Right.
And just taking death off the table is mathematically worth a 100% rally from those absolute lows.
Okay, that makes sense for a V-shaped recovery. I get that. But not dying isn't a long-term growth strategy. You can't just save your way to success forever. Eventually, you have to actually make something people want to buy.
Absolutely. And that brings us to the second main pillar of the analysis report, which is the actual strategy. CEO Pat Gelsinger's IDM 2.0.
Yeah, I always hear this buzzword thrown around, IDM 2.0. It sounds like corporate marketing speak. What does it actually mean for the nuts and bolts of the business?
Well, it's arguably the biggest gamble in the entire history of the company. Historically, Intel was an integrated device manufacturer. They just designed their own chips and they built them in their own factories for themselves.
Right, a closed loop.
Exactly. But IDM 2.0 means they want to split that and do two things at once. First, they want to restore dominance in designing their own x86 CPUs, the processors in your laptop. But second, and this is the crazy part, they want to build a world-class third-party foundry business.
A foundry, so making chips for other people.
Just like TSMC in Taiwan, Intel wants to build factories that manufacture chips for other tech companies, even their direct competitors.
Which is absurdly difficult to do, right? I mean, TSMC has spent, 30 years perfecting that exact model?
It is incredibly difficult. It's borderline hubris. But here is why Wall Street actually changed its mind and started buying into Intel trying this. It's not just about the business economics anymore. The report heavily highlights the geopolitics.
Oh, the too big to fail narrative.
The Uncle Sam angle, yes.
Mm-hmm.
Think about the world map right now. Something like 90% of the world's most advanced chips are manufactured on one single island, Taiwan.
Right.
If anything happens in that region, a blockade, an invasion, or honestly, even just a massive earthquake, the entire global economy grinds to a halt.
So the U.S. government is looking at Intel and basically saying, we literally cannot afford for you to screw this up.
Exactly. That is the whole reason we have the U.S. Chip PS Act. That is why billions of taxpayer dollars are flowing directly into these new Intel factories. Wall Street suddenly realized that Intel has a massive government-mandated floor underneath it.
A geopolitical premium.
Right. The government is essentially backstopping the company because America desperately needs a U.S.-based manufacturing alternative to TSMC.
It's like a giant insurance policy built right into the stock price. But let me push back on that for a second. Just because the government throws a bunch of money at you doesn't mean you'll actually be a profitable, well-run business. I mean, Amtrak is too big to fail, but I certainly wouldn't want to own their stock if they were public.
That is a very fair criticism. Subsidies ensure survival, they don't guarantee prosperity. But the difference here, according to the analysis, is the product roadmap. For the first time in years, Intel is actually hitting its engineering deadlines.
Okay, yeah, the report lists these code names, Meteor Lake and Panther Lake. To the average person listening, these sound like sci-fi movies or maybe weird vacation spots. Why do these specific chips matter so much?
They matter because for an entire decade, Intel was famous in the industry for one thing, and that was delays.
Right, the endless delay.
They would promise a revolutionary new chip, and it would arrive 3 years late, and it would run as hot as a toaster.
Yeah.
But Meteor Lake and Panther Lake actually arriving on time, that was the signal to the market that the engineering rot inside the company has finally been fixed.
So the engineers are actually executing again? The adults are back in the room?
Yes. So you combine the narrative of the U.S. government won't let us die with, hey, our engineers actually figured out how to ship a product on time, and you get a very strong foundation for this stock rally.
Okay, so we have the less bad financials, we have the geopolitical safety net, and the execution is returning. But I really want to talk about the competition now, because this is the part of the report where I get genuinely confused. We have to talk about AMD.
Ah, yes, the arch nemesis.
Right. I look at AMD, and they are trading at this just massive multiple. The report notes they have a 75 times PE ratio. They're the absolute darlings of Wall Street. They grew 34% year over year, fueled by AI. And then you look at Intel.
Negative trailing PE.
Exactly. A negative PE because of all those past losses. So why would any investor buy Intel when AMD is sitting right there growing at 34%? It feels like betting on the horse with a broken leg just because the payout odds are slightly better.
The report calls this the valuation paradox. And to really understand it, you have to understand the fundamental difference in their business models. Think of AMD as an architect.
An architect. Okay, I'm tracking.
They draw the blueprints. They design this beautiful cutting-edge building. And they sell those plans for an absolute fortune. But they don't actually pour the concrete.
Because they outsource it.
Right. They pay TSMC to do the dirty work of manufacturing. That is why AMD's margins are so high and their cash flow is so clean. They are what the industry calls fabless. They don't own fabrication plants.
Okay, so it's a high-margin, low-overhead business.
Exactly. Now, on the other hand, Intel is the construction crew. They're the ones buying the massive cranes, the cement mixers, the land. They are paying the factory workers. That is unbelievably expensive. It is hugely capital intensive.
Which perfectly explains why Intel burns cash while AMD is just printing it.
Right. But here is the critical part for investors, the call option theory. When an investor buys Intel at $17, or even today at $46, they aren't buying it for the earnings it has today, because there really aren't any.
Right.
They're treating the stock like a call option, like a lottery ticket attached to a blue-chip tech company.
Break that down a bit more.
They are betting that if the construction crew actually finishes the factory, and if that factory is genuinely state-of-the-art, Intel suddenly becomes the second most important manufacturer on planet Earth.
Wow.
If that foundry model succeeds, the stock shouldn't be $46. It should be double or triple that. So you are paying a relatively low price now for the future possibility of that massive foundry success.
So you're paying for the potential.
Exactly. And we are seeing early signs of financial efficiency returning to support that. Intel's gross margins are finally bottoming out around 36.7%, and their operating income swung from a loss of $265 million in 2024 to a profit of about $2.9 billion in 2025.
Okay, that is a real swing. But that construction work you mentioned, it is just brutal on the bank account. I want to shift and talk about the cash burn because the report calls this the heavy metal phase, and the numbers are just eye-watering.
They are immense. This is the absolute peak of their capital expenditure pain.
The report notes that Intel burned negative $4.9 billion in free cash flow in 2025, almost $5 billion just out the door. How is that sustainable for any company?
Well, it isn't sustainable long term. But again, context is literally everything here. Do you know what their free cash flow burn was in 2024?
Lay it on me.
Negative $15.6 billion.
Oh my God.
Yeah.
That's terrifying.
So yes, burning $5 billion in a year is very painful. But it is roughly 1/3 of what they burned the year prior. The actual rate of cash incineration is slowing down dramatically. The market firmly believes that this heavy spending phase is peaking right now, and they will transition to actually printing cash by 2028.
But how do they even manage to cut that burn rate so fast? You don't just find $10 billion in the couch cushions. Was this all just firing people?
That was a huge part of it, and the report makes sure not to gloss over that. There were thousands and thousands of layoffs. That is the very real human cost of a corporate turnaround like this. But it wasn't just generic, cutting headcount. They actually did some serious structural surgery on the company.
The report mentions they exited non-core businesses. What does that actually mean in plain English?
For years, Intel basically suffered from shiny object syndrome. They tried to do everything. They were making drones. They were making those little NUC mini PCs. They had memory businesses. They were dabbling in everything and mastering none of it.
Right.
When Gelsinger came in, he started amputating those distractions. He spun off the Altera programmable chip business. He killed the mini PC line. He essentially looked at the company and said, if it isn't a core CPU or a factory, we simply aren't doing it anymore.
So they just stopped the distracted spending entirely.
Exactly. They focused the machine. And that cost cutting is why the margins are finally creeping back up near break even.
Okay, so we've stabilized the patient, they've cut off the distracted side projects, and the U.S. government is helping pay the hospital bill. But now we actually need the patient to get up and run a marathon. What is the actual catalyst here? What takes this stock from a recovery story to a genuine growth story?
According to the analysis, it all comes down to one single thing, one specific code name, 18A.
18A. Yes, I see this referenced everywhere in the report. It's treated like the Holy Grail. But what actually is it? Is it a new chip? A machine?
It's a manufacturing process node. To keep it super simple without getting bogged down in engineering, chips are obviously made of microscopic transistors. For the last 10 years, TSMC has been successfully building microscopic skyscrapers, while Intel was stuck building two-story houses.
Their technology just fundamentally fell behind.
Right. The literal size and efficiency of their transistors fell behind. 18A is the moment Intel officially catches up. It stands for 1.8 angstroms. It is the specific manufacturing process that Intel claims will put them back on technological parity, or maybe even slightly ahead of TSMC by the end of 2026.
So this is basically the put up or shut up moment for the entire company.
Completely. The report explicitly calls it the show me story. The stock holding this $46 premium depends entirely on the 18A node working perfectly. If the chips coming off that 18A line are fast, cool, and cheap, Intel is officially back in the game.
And if they aren't,
then the entire investment thesis breaks. The stock will crater. But honestly, there is another huge layer to this risk that we have to talk about. It's not just an engineering problem of can they build it, it's a business problem of will they come?
Ah, the field of dreams problem.
Exactly. You can build the most advanced factory in the world with the absolute best 18A transistors. But if NVIDIA and Apple and Qualcomm don't actually trust you, if they decide to just keep sending their designs to Taiwan because they already have a 20-year working relationship with TSMC.
Then Intel just has a very expensive, very empty factory.
Exactly. If they can't secure a major external client for 18A, it's a disaster. But if they do land a massive client, the report notes the stock could violently gap up. That's the catalyst.
And that's the scary part for anyone listening right now, isn't it? We know Intel can pour concrete and build labs. We don't really know if they can do customer service for other tech giants.
Right. Intel is very used to being the undisputed king. They dictated the terms for decades. They aren't used to being the humble service provider. Culturally, that is a massive, massive shift for them.
What are the analysts saying about the actual price targets right now, given all this risk?
The current consensus is sitting around $47.10, which is basically right where we are trading today. So they think it's fairly valued for the moment. But the bullish outliers in the report see it going to $60 or higher by late 2026 or 2027 if the foundry model actually scales.
But there are near-term risks too, right? I see here the Q1 2026 guidance is pretty soft.
Yeah, they are guiding for 11.7 to 12.7 billion in revenue for Q1, which isn't great. Plus, from a technical perspective, there is huge psychological resistance at the $50 mark. The stock is going to struggle to break through 50 without major news.
Though it is interesting to note that Wall Street sentiment has clearly shifted. The report says the sell ratings have mostly capitulated during this run-up, and now it's shifted to a cautious hold.
Nobody wants to bet against them right now, but nobody wants to go all in either until they see the 18A results.
Makes perfect sense. Before we wrap up, I want to touch on one last thing. AI. We cannot do a tech deep dive without bringing up artificial intelligence. Everyone knows NVIDIA owns the AI market right now. Is Intel just completely watching from the sidelines here?
Not entirely, and the report makes a point to clarify this.
Yeah.
Yes, they completely missed the first massive wave. They missed the training wave, those huge, expensive chips that ChatGPT and those models run on. That is NVIDIA's territory, period.
Right, NVIDIA won that war.
But the report points out that Intel's data center and AI segment, which they call DCAI, actually grew 9% year over year.
I mean, single digits. That's not exactly explosive AI growth.
No, it's not. But it proves they aren't totally obsolete. They are selling chips for what's called inference, which is basically running the AI models after they've already been trained. That 9% growth reassured the market that while they aren't the leader, they aren't locked out of the AI cycle entirely.
Which I guess goes right back to the less bad theme we started with. They don't have to beat NVIDIA, they just have to prove they are still relevant.
Correct. Capturing even a small slice of a massive AI pie is enough to help the bottom line.
Okay, so let's try to bring this all together. We have a stock that has rallied over 100%. The financials are still pretty ugly, but they're clearly improving. The U.S. government is heavily backing them, and the entire future rides on this 18A manufacturing technology. What is the final takeaway for the person listening to this right now?
I think I'd leave you with this provocative thought from the analysis. The market has now completely priced in the survival of Intel. That easy money riding it from $17 to $46, that was the survival rally.
The they aren't going bankrupt rally?
Right. But now comes the really hard part. To get this stock from $46 to $60 or $70, Intel has to prove it can actually thrive. The easy, relief-driven gains are gone. Now they have to flawlessly execute, they have to land a massive customer for their foundry, and they have to prove that 18A is the real deal.
So the message is basically, the ambulance ride is over, you're out of the hospital. Now you actually have to go win the race.
And that race is a marathon, not a sprint. The report makes it very clear that 2027 and 2028 are the real finish lines here.
Yeah.
Everything until then is just preparation.
Well, it is certainly going to be fascinating to watch. It's incredibly rare that you get to see an industrial giant try to completely reinvent itself in real time like this. Thank you so much for breaking down all these numbers with us.
Absolutely. It was a great discussion.
And to everyone listening, keep your eyes on the chips and watch out for that 18A milestone. We'll see you in the next deep dive.
Don't forget to like, share, and subscribe for more.